Hello, everyone, and welcome to What to Expect in the Upcoming Tax Season. This webcast is brought to you by CPA Practice Advisor and Drake Software. I'm Gail Perry, Editor-in-Chief of CPA Practice Advisor, and I'll be your moderator today. Before we get started, I'd like to explain how continuing education for this webcast works. The webcast qualifies for 1 credit of continuing professional education, and also, if you need it, it qualifies for 1 credit of IRS continuing education. If you plan to earn credit for attending this session, you must stay with us for at least 50 minutes. In addition, we will display 4 polling questions during the webcast. You'll need to record an answer for at least 3 of the questions, as this is our verification that you are still watching. Later today, you'll receive an email from CPA Practice Advisor that contains a link to your CPE certificate, assuming you met the requirements for CPE. If you need IRS CE credit, we did not ask you for your PTIN number on registration. You can go ahead and enter it in the Ask a Question box, and we'll record it there. That's if you need CE credit from the IRS. If you don't have your PTIN handy, we'll tell you at the end of the session how you can email it to us so we can give you that credit. Please note that we can also give continuing education credit for multiple people watching on the same computer. So if there are others in your office who would like to attend this event at the same computer, please have them join you now. And at the end of the event, we'll provide an opportunity for you to send us their email addresses so they too can receive credit. At any time, you can enter any questions you might have in the Ask a Question box provided on your screen. And our speakers will try to get to as many questions as possible during the presentation. Questions not answered during this live webinar will be addressed by the speakers afterwards via email. The slides for this broadcast are available for download. There should be an Event Resources option at the bottom left of your screen where you can click and get the PDF of these slides. If you don't see Event Resources on your screen, please refresh your screen and it should appear there at that time. Today, we're joined by LaDonna Keener, Bob Nolan, and John Sapp from Drake Software. I'm going to have each of them introduce themselves right now. We are ready to begin.
Great. Thank you, Gail. I am John Sapp. I am Vice President and a Brand Ambassador at Drake Software. And this will be my, I was trying to do the math, 36th tax season, I think. And every year is a little more interesting than the next. But I'll ask LaDonna if you'll introduce yourself, kind of say what you do at Drake, and you can tell me how many tax seasons you've had or not. I'll leave it up to you.
Okay. Hi, everyone. My name is LaDonna Keener. I'm a CPA licensed in the state of North Carolina. I've been with Drake Software particularly for the last 16 years, and I am the manager of the federal tax development team. So my team puts out the 1040, 1041 Corp, S-Corp tax exempt products in the software. So it's good to be with you today.
Thanks for being here, LaDonna. Bob Nolan.
Guilty as charged, Your Honor. Bob Nolan, I'm a tax analyst at Drake Software, and on Friday, that'll be my 18th anniversary at Drake. I'm a CPA licensed in Illinois and North Carolina. I'm also an enrolled agent, and basically I'm a tax geek.
This is our brain trust, and I really appreciate you guys taking time out of your busy schedule to be with us today. So the title of this webinar is What to Expect in the Upcoming Tax Season. One thing we have learned is every tax season brings its own set of challenges. This one will be no different. We do not know as of this date when our filing season will start, but we are optimistic that it will start, and will start in a timely fashion so that we don't have compression of the work that we have to do. So our objectives today is to talk about some of the tax law changes. We'll also hit just a little bit. I'll do kind of a lightning round with Bob and LaDonna and just kind of mention some of the tax proposals that are on the table as of probably last week. I don't know. I haven't seen, seems like a new tax proposal comes out based on the crowd that any particular presidential candidate is speaking to. More so than previous years, it seems like we're getting a lot of talk about tax changes in the presidential campaign as much as anything else. It seems like we have a headline every day. So we'll talk a little bit about that, impact of some of the technologies on our profession, and then some of our changing reporting requirements when it comes to things like B of I and 1099K. So let's jump right in to our webinar today. We've already introduced everybody. We're going to go immediately to a polling question. So let's go ahead and pop that up on the screen.
All right.
Some of you are just sitting down. Sorry, go ahead. I'm sorry.
Okay. Okay. So our first polling question is, what is the biggest challenge your practice will face in the upcoming tax season? And the choices are changes in technology, dealing with misinformation on social media, implementing security requirements, getting old, or other. And if you have any difficulty answering the question on your screen, like if you're on a mobile device or something, sometimes it's hard to answer the questions there. You can go ahead and type your answer in the Ask a Question box, and we'll record it there.
So, and I'll ask Bob and LaDonna as we kind of wait on some of these poll results, and I'm going to share them with the audience here in just a minute. But so Bob and LaDonna, of those choices, which one do you think, as you've talked to preparers, that they are going to deal with the most, or it's going to be the biggest headache during the upcoming filing season? Any opinions?
Well, I'll go first. I think misinformation on social media. Social media is a big part of the world we currently live in, and especially with it being an election year, there's been a lot of misinformation. So that tends to lead to a lot of confusion and questions. And in particular, some of the recent like ERC things that we were dealing with, there was a lot of misinformation about that, and it caused some real headaches for people. So I think that will continue to be a problem as we go forward.
Definitely.
Bob,
agree.
what do you think?
Definitely agree. I can't worry about getting older because I already did that. It's too late for me to worry about it. But actually, I spoke recently with some people at IRS who were very concerned about what's on social media. And especially, apparently, there are like TikTok videos about how everybody gets a gasoline credit. Fill out a fuel tax credit form and send it in with your tax return and get free money. It's kind of concerning.
Fuel tax credit, probably the biggest thing. To some point, with social media being the biggest challenge that a lot of our preparers are going to face. At the same time, I think part of that dealing with the younger generation coming in and the types of social media they're using has a larger variety than what maybe some of their preparers that are maybe a little older are utilizing. I can't even name half the social media accounts that those folks use, and they end up relying on them a lot for their news. Like if you the technology changes, and that's our first topic here. Some of the technology changes. I'll just tell a funny story. My granddaughter was staying at a hotel with her mother and father, and we decided to slip over and see them. And when we came in, she came running up, and she was all excited. She's 4 years old, and said, "Papa, you won't believe this. This is an awesome hotel. We have live TV, and they have commercials." And she was enamored with the fact that they had toy commercials for the cartoons, because a lot of them don't even have, regular television. They just have YouTube or one of the other providers of TV. So technology is changing, and the way people get their information is changing. Definitely a challenge in the previous year. But the first topic that we were going to mention as far as technology was the use of AI. I think Thomson Reuters did some research on this of how are tax and accounting firms utilizing AI, and 77% of firms said it can be applied to their work, but only half of them said it should be applied. And similar changes, to me, this is similar to when we went from handwriting tax returns to using a computer. I remember for a long time, it was a big knock on a preparer that couldn't do a tax return by hand. Well, today it's going to be at some point, if you're not using it. Bob and LaDonna, I'll let you both comment on some of the pros and cons of use of AI. And do you think there are any applications for AI today in a tax and accounting practice? What do you think? LaDonna, why don't you go first?
Okay. I think that we have a couple of real opportunities with AI. I'm like Bob, I'm a little older, so I'm a little old school. When I went to high school, I took typing. I didn't take computers. So it was a little bit frightening to me, and I have discounted it for the last few years. But what I have come to realize is AI is here to stay, and it's going to be a part of our future. So what we have to do is figure out how it's going to work in not only our daily lives, but in our practice. It's probably already working in your daily lives. If you're talking to Siri or Google, you're talking to an AI. So it's already a part of your life. You're already somewhat comfortable with it. So why can't we utilize it in our practices? I think one of the big things would be our communications with our clients. I think AI would be a great facilitator for some of that communications. We're not all well versed in the written word. So I think using AI for engagement letters and trying to parse out complicated tax code answers in a grade level that some people would understand, because when we all don't understand tax code, we can use AI to do that type of thing. So I think there's real potential for AI. It's just we're going to have to be conservative about it to begin with until we're comfortable with it, and utilize it. And then definitely you don't want to use AI and put any personal information on it. So,
and anything else that's brand new out of the box, it's nothing is ever perfect, and I'm slightly terrified, truthfully. Sometimes with automation, with advanced high-speed computers, what you've done is create a way to make a whole lot of mistakes very quickly. Tell you a story from kind of a long time ago when fax machines were new. And there was a guy who set up his fax machine, and he thought he had everything up and running correctly, and he found out he started getting phone calls. He had faxed 400 blank pages to each of his clients. And this is when he had that roll of thermal paper.
Paper.
So
for some of our attendees, you may have to Google fax machines and get a picture of one to see what they look like. So, so it is a little dated, but I argue with that. And one of the other things that has not a lot of angst, but at least is giving people pause to some degree, is the IRS is using AI to select potential candidates for audit or examination. We did listen to the guy in charge of that at a conference in DC, and they basically said they felt like they had recovered an incremental $26.1 million, 5 to 10% revenue increase, and about a 3 to 5% decrease in no change audits. So they felt like they were seeing some benefits from using AI in audit selection. Of course, there are always some risks associated, as Bob pointed, utilizing new technology. And as a result of that, there are guardrails around the use of AI in government. There's also some fear out there. There have been some congressmen that have introduced the No AI in Audits Act. It's been introduced in the House, so to preclude the IRS from using AI in the audit selection. So the some of the bigger questions there to me is any AI model has to be fed with data, and is there any type of consideration to use data that is outside the statute of limitations? Is there any requirement to gather other data from the Census Bureau? For example, if the IRS is going to one's non-tax data, like where they live, if they lived in a blue area versus a red area of the country, or vice versa, if they, so is to have the IRS make their AI principles in the internal, has to be transparent, has to be understandable how they're doing their modeling and monitored, and it has to be according to the law. So sometimes our priorities at the Internal Revenue Service may get a little mixed with political priorities. The IRS stated position is they try to be apolitical, but in our current environment, any environment, whenever you have a treasury, which is a political appointee, you have an entire division working for that, then obviously there's going to be political considerations. Bob LaDonna, do you have any other thoughts on the use of AI by the Internal Revenue Service?
Go ahead, Bob.
Well, actually, I don't want to play the Luddite here and think technology is bad and scary, but I have to confess, to me, AI is a little scary. I would like to have the government periodically update what it's using it for, what kind of successes and failures there have been. I'd like some accountability, I guess.
Clear parameters set for the use of it.
I think that all of us remember the line, "Open the pod bay door, Hal," where the computer took over the spaceship in Space Odyssey. I think all of us kind of have that picture in my mind with AI sometimes. If it's that, I don't think I'm that smart anymore. I don't think I ever was that smart. But if there's a machine that's smarter than I am, he could probably, take over my pod bay door where I can't. To our next polling question. So I'll turn it back over. Renee, is that you doing the polling questions?
All right, here's polling question number 2. Which best describes your thoughts on the use of AI by the IRS? And wait, which best your thoughts? Sorry.
No, that's right. Yep, you're right.
Will impact tax pros. Oh, on the use of the IRS will impact tax pros. Sorry, I'm just having a moment. Okay, here are your answer options. I'm optimistic it will lead to fewer selections of accurate returns. I'm concerned about the accuracy of audit selection. I'm concerned about bias toward particular groups in audit selection. No concerns here, bring it on. Or other. So pick the answer that seems most appropriate in your case. And again, if you have any difficulty answering that question online, you can post your answer in the Ask a Question box and we'll pick it up there.
Okay. When it comes to AI, I find it extremely interesting. Used to be, we would always use the concept, before you automate something, make sure you know how it works manually. And if I know how something's going to work manually, then I can check the automated process. In our software, we used to have, I don't know if we still do or not, the ability to do what's called hash totals. So you could make sure a particular set of data was keyed in correctly on a screen back when we had data entry operators. And all technology should have some types of checks and balances. And I think what makes a lot of us uncomfortable with the AI, even if we saw the publication of the AI models, which even though it's in the Internal Revenue Manual, I got to tell you, I think that the IRS is going to be very hesitant to publish enough detail for us to know how to check the accuracy of the AI. They are very, we were talking earlier about some of the FOIA requests that the IRS has turned down recently, they are very hesitant to share enough data out into the world or out into the wild that would allow a fraudster to take that data and manipulate their submissions in a way to bypass those particular data streams. So give it just one more second. I'm going to go ahead and send these results to the audience. So you can see concerned about the accuracy and concerned about bias toward particular people groups are our two largest segments there. But we have a pretty good chunk, almost 10%, don't have any concerns. And we should just bring it on. And I would suggest you watch 2001 Space Odyssey first before you answer that question.
I would almost be interested in age dynamic toward that whole.
Yeah.
Oh, good point. That's a great question. So we have TCJA, mostly legislation, and the expiring tax provisions. And this is where, I think we have Democratic platforms and Republican platforms. But I'm curious, Bob, LaDonna, if any of these concern you the most in 2026 if they do expire. Which do you believe would impact our preparers and, by association, taxpayers the most? Which one concern you the most if they do expire?
I think the biggest one's probably the standard deduction. Because the threshold for itemizing is going to be much lower with the expiration. And the other thing that I really hope that they keep, even though calculating it is kind of a pain in the neck, is the qualified business income deduction. Because in my mind, that went together with the reduction in the tax rate for C corporations. C corporations are getting a reduction in their tax burden. Why wouldn't partnerships and S corporations get something similar?
QBI was my largest concern. And actually, I have not seen anything. There have been some indications that some things would or would not stay or come back. QBI is not one of them that I've heard anything about. It feels like it's one that's going to move away. We'll see.
I think all sides have said to some degree they would like to see the SALT limits either changed or removed. But there's a perfect storm here if they pick and choose what gets removed and what stays, right? If the standard deduction goes down, but none of the itemized deduction limitations are removed. In other words, they put back the PEAS limitation, they keep SALT, or unreimbursed employee business expenses stay gone. Then all of a sudden you have a pretty substantial tax increase without ever changing the rate. I don't know how you calculate the hard limit on people under X number of AGI, and they're not going to see a tax increase. Any of these levers could have negative consequences for multiple areas for taxpayers. And I think when LaDonna, I think at one time when we were discussing this, you had mentioned, and I'm curious if you have any additional thoughts on it, late legislation, the timing of the legislation could impact tax season just as much or more than the legislation. What did you mean by that?
Well, late legislation, even as late as this year, because we're a development company. So it's very hard because legislation comes down from Congress and then the IRS has to turn around and revamp all the work they've already done to prepare for the upcoming tax season and then parse it out to us as developers. And then we have to turn around and interpret it. It's not a stop on a dime and turn around process. So always late legislation is a huge problem. And then in addition to that, it's very difficult for state legislations to get together and meet to decide if they're going to follow the federal tax law changes or decouple from it. So that adds another layer of complexity to these late changes that happen. And they happen more often than not.
Late changes are one of my least favorite things in life. I always tell people this. I like it when one political party has the House and the other has the Senate, and they can't agree on anything, and the tax laws stay the same. Just because it makes my life so much simpler. Selfish of me, I know. But.
Well, I don't think you would have a lot of folks on this call that would disagree with you as to tax law changes, although part of the reason we all are in business is because our tax law is so complicated, and every time it changes, it's like a boost to our potential business that we have to help people navigate those waters. So kind of right, we hate the pain in the neck that it is anytime there's a change, especially if it's a retroactive change. Mm-hmm. I mean, if we had an election year this year and we ended up with some type of split House and Senate, which it looks like could potentially happen, and you have a party in the White House, for them to agree, there's going to have to be a lot of compromise. To me, one of the worst case scenarios is the compromise includes something that is retroactive from, they pass it in July and it becomes retroactive back to January. And of course, the IRS still manually processes all of our amended returns. They print them out and then key them back into a different system. And then we end up with 12 million amended returns, or we rely on the IRS to calculate it on the back end, which seems like is becoming the assumption. We went through that with late legislation the first time when we had expiring Bush tax cuts. Whenever we could do it that late because they passed it in December, and then we turn around and do it every year now because I wonder if the IRS calculating, with unemployment a couple years ago, calculating those results on the back end, or the way that they executed on EIP or the different payments that were made during COVID. That becomes an expectation now, and it's assumed that any legislation they pass, we can execute on. So,
well, unfortunately, there is legislation out there now that would be retroactive, but the general consensus is that nothing will be acted on before the end of the tax year. So,
child tax credit, one of the worst to be retroactive, because then you're talking about refunds being. That's a good point. So let's think about the two. I know we don't have a slide on this, but we do have, as I mentioned earlier, we have a little bit more insight into the different presidential platforms that are out there. Trump reduced the corporate tax rate down to 15%. Neither one of them want to tax tips. What are your thoughts on taxing tips? The other, I think Trump also says, don't tax overtime pay. And I think either one of them says, I think it's Trump that says, let's don't tax Social Security benefits. Any of those three kind of jump out at you as an interesting tax proposal, either from an administrative side or just from a tax person side? What do you guys think?
I'm actually a little confused by the no taxing of tips, because it seems to me that tips are one of those nebulous things that probably get either over or under reported. And yeah, so now it's going to go the opposite way, I would think. And people are going to want more of their income to be reported as tips than non-tips. So it just seems very interesting. It's a very industry-specific type of tax break.
It has been kind of,
and no tax on tips. A lot of those folks are probably qualified for the earned income credit. So if you take that out of their earned income, it could end up reducing their earned income credit. Sorry, Bob, go ahead.
I was just saying the record keeping has always been kind of spotty. And it would not only make life simpler, but also, I hadn't thought of John's point, reducing the tax burden on people who mostly are in low wage jobs. It seemed like kind of a good idea to me. As we were talking earlier, The other thing that stands out, LaDonna mentioned, taxing Social Security, because you were already taxed on the money that was taken out of your paycheck to fund it. Now you're just getting part of it back. And that feels like a much more fair situation, not taxing Social Security benefits.
It's definitely double taxation.
I wonder if we did a poll on that, if we would see an age disparity, and the answer, should it be taxed, yes or no?
Awesome.
Sorry, that's probably not funny. The other thing about the two different tax proposals, Trump has definitely said he would make all of these tax provisions permanent. And then the other thing he has mentioned, and it has only come up once or twice, is replacing the income tax with a tariff on goods coming into the country. Either of you have any thoughts about that tax proposal?
So it feels like increasing the tax on tariff is eventually going to trickle down to the everyday person, because that's on our goods that we import from overseas. And so much of what we buy at our local stores is actually imported from overseas. I'm pretty sure that cost is going to be passed on.
It's one of the, just in general, over the years, every candidate from both parties, they seem to leave out the fact that when they talk about we're going to tax the big company or we're going to tax the foreign company, or ultimately the person paying it is the consumer buying the product. So you're not really reducing the burden on the average citizen by doing that. You're just getting the money from him or her in a different way, if you see what I mean.
So at the end of the day, the House has to present any tax bill, has to originate in the House, although the Senate can go to the House and try to get them to produce a tax bill. So if we have a democratically controlled House and a Republican controlled Senate, getting any bill introduced is going to be more difficult. Whereas if we have vice versa, getting any bill passed will be more difficult. So we could see some political movement there, or some political posturing. Of course, we're going to see political posturing. Sorry. I mean, to state the obvious, by the types of bills that are introduced. So it could get very interesting. All of one particular party's bills could be produced in the House if that party controls that House of Congress, but then the other party may end up just nixing it down and making their own political statements. So we'll see how all that works out. I think all of us are hopeful that at least some of these, based on the conversations that are going on today, both parties have created strategic teams to try to address the expiring tax provisions and kind of do the scorecarding and the political motivations behind each one of them. So, it depends on where they draw the lines, what we'll see coming out of each of those legislative proposals. So let's move on. And let's talk about something we know is changing for sure. That's the unknown. And that's 1099K reporting. So 1099K is the reporting of merchant, what we would think of as merchant account statements, credit card, debit cards, stored value cards, gift cards, anything paid for services through that electronic system. And a lot of this comes from the tax gap estimates and the tax gap proposals. One of the learnings, I should say, or published learnings from the tax gap last year, they've reintroduced it this year, was that when something is reported onto the IRS, the compliance with the law for that particular reporting item goes up. So, for example, 1099 miscellaneous being broken out in the 1099 NEC, they feel like that may have moved the 1099 independent contractor reporting income up. So the compliance level, the tax gap would have slowed in those particular areas. 1099K is one of those. So today, if I receive a 1099K, how would I normally report that? If I had a Schedule C, I would normally reconcile the income on the gross revenue line, maybe list out the 1099Ks, maybe not, probably not matched up. What's the difficulty here, Bob and LaDonna, that you see from having more 1099Ks in the system? And is the IRS doing anything about that to help mitigate, the reconciliation burden that's going to fall on preparers?
I'll let Bob talk to some of the changes that are on the form for this year. I don't know that they particularly. Go ahead, Bob.
Sorry. Last year, if you got a 1099K that was not for business, for part of a business that you ran, if it was the result of a gift or splitting the cost of something with an acquaintance and the funds moved electronically, you had to wash the income in and out on your 1040, and it was kind of an awkward product. I'm very happy looking at this year's draft tax forms that there's a new line on Schedule 2 that just says enter the amount of any 1099K that you got that should not be included in income. Once in a while, they do something nice for us and simplify something for us, and that was one that made me real happy. The other thing that's always been a problem with them is the 1099K is gross income, and it includes things like, for a restaurant business, it'll include the tips that were given to the wait staff in that amount. Well, that's not income to the restaurant. And that creates kind of an awkward reporting situation.
Sales tax.
Sales tax, biggie.
So we see the 1099Ks coming through. I guess the biggest fear is an influx of incorrect 1099Ks issued for non-taxable events, and the burden that's going to be placed on tax preparers and taxpayers as they have to find a way to report this. So the first step was to delay implementation, which we're not going to get into in debate whether the IRS has the authority to do that, but they did, and we're all pretty happy they did, because I felt like, especially the Venmos of the world and PayPal's and the electronic payment transfer companies, they'll pay for every payment, which to your point, Bob, was going to require reconciliation, which is very difficult. Still happens, and we know there's going to be some incorrect payments for next year, but at least it gets the 5,000 or above threshold this year. It'll go down next year back to I think it's $600 next year. And then we'll end up in a situation where we have to just pull the Band-Aid off eventually, right?
Exactly.
So let's move on to our next topic. Which of these, we have the employee retention credit hangover, where we still have individuals attempting to, we'll talk about that in just a second, a little bit more. But let's flip right over to the Corporate Transparency Act. And LaDonna, this is kind of something I think that is something that you have had to deal with from the software side, trying to get the information out, the appropriate information to preparers that may or may not be dealing with this. But just give us the high-level overview of the Corporate Transparency Act and why we should care.
Mm-hmm. So if you're not real familiar with it, the Corporate Transparency Act put out the requirement for beneficial owner information reporting that is to be done through FinCEN. FinCEN is the arm of the Treasury that looks for financial crimes. And so the requirement that is out there now is that every business that is registered with some state authority, there are exceptions, specific exceptions listed, will have to register with FinCEN, and they have to give them some important PI information. So the burden is for us as tax preparers is whether or not we should even be doing this for our client base. And the general consensus is maybe, probably not, but maybe so. And are we the right person to do that? There's a lot of confusion on when things need to be done and how they need to be done. FinCEN and BOI reporting information is not part of the normal tax process. Okay, it's not part of their tax return. It is a basically one-time, typically, reporting when the organization does its filing or registration with the state. And they basically have to turn over some personal information on who the beneficial owners or the primary officers are of an organization. And you have to provide them things like copies of driver's license and who the registered agent is for the organization. There's specific information. Now, I think once you get in the site and try to do that registration, it's not a terrible process. It's like a 20-minute process to get that work done. I think the hard part is gathering that information together and then actually putting it in. But the hard part for us as preparers is maintaining that. And how do we keep our customers, our preparers, our clients out of trouble with FinCEN, because there are some very specific requirements on updating information. There are time-sensitive requirements. There are some onerous penalties if these things are not met. So I think a lot of our liability insurance companies have told tax preparers, so you might want to check with yours, and have said that they would not support your business, your D&O insurance, if you provided this service. So you want to be sure that your insurance company is not going to give you a hard time about doing this, or if you choose to do it. I think it's a fine line on whether it's legal services. I don't think it's necessarily legal services, but I think at the time going forward when registration is done for these particular businesses of the state, a lot of times we use lawyers and attorneys to file those registrations. There's no reason why they can't do this reporting for you at that time. So you've got to put a lot of thought in.
I just say, yeah, I agree with you 100%. I'll just say this. If the accountants and CPAs and enrolled agents don't do it, it is not going to get done.
Probably not.
And LaDonna has brought up all of the issues, and the communication is the number one issue. It took FinCEN halfway through the year to put an FAQ out that said, yes, your accountant can even do it. But it didn't say you can do it and your E&O carrier is going to cover you. Most, for example, the ASCPA has come out and said their Aon, I think it's Aon insurance will cover the B of I reporting, sorry, B of A. But not all E&O carriers, I've heard from preparers, not all E&O carriers are going to do that, especially if your practice is just tax, it seems like, and you're not covered for things like accounting work or other ancillary services that you may do for clients. So, because this is definitely not a tax event, but if we don't do it as preparers, it is not going to get done, and a lot of our clients could end up in trouble, and then coming back and saying, "Why didn't you tell me? Why didn't you do it? I thought this was all part of your service that you provided." So it puts us in a.
It is a little scary.
What's that, Bob?
Bringing up that.
Yeah.
Because a lot of times you have clients that there's a small Schedule C, a single member LLC. They have this filing requirement. They rely on you to do it. They move in March, and you blow the deadline to update the filing. And there's going to be a discussion about whose fault that is and who owes the penalties. And you're liable to get the fuzzy part of the lollipop at that point.
And to the point, 30 days, right? They have 30 days anytime something changes.
So there are reasons to stay away from this as a practitioner.
So address changes and the Schedule C's have to file. I think I pointed this out earlier, but anything formed at the state level. So a Schedule C is not formed at the state level. Basically, corps and LLCs
Yeah.
subject to some exemptions.
So if it's a disregarded entity with a registered LLC and it files as a Schedule C, they would have a filing requirement.
Exactly. Great point,
And that's
LaDonna. If
not
it's a
true.
disregarded LLC filing Schedule C, they do have a filing requirement. If it is formed at the state level, regardless of the tax return they filed, they have a reporting. You might as well assume they have a reporting requirement unless they're nonprofit.
I will point out the BOI has a really great website. If you, I don't know if we have it in our documentation, but if you just Google FinCEN BOI, it's the first thing that'll pop up. Right there is where you actually do the filing. They give you great directions on how to prepare the documentation to do the filing. They have all the FAQs. They tell you who's responsible, who is required to do it, who is not required to do it. They probably one of the best put together websites I've seen on that type of explanation. So I would highly recommend you review that. It's where you're going to go to do the filing in the first place. So.
Okay, that takes us to our next polling question. We'll go to polling question number 3. Gail, is that you?
Yep, that's me. Okay, question number 3. What % of your clients with a BOI reporting requirement will actually file with FinCEN? Okay, the answer responses are less than 10%, more than 10%, but less than 50%, more than 50%, or none of my clients will comply. Wow, that's a loaded question. Let's see how people answer that one. Go ahead and pick the answer on your screen that most applies to your practice.
And while we're doing that, I think I'll try to hit some of the questions in the chat. Couple of questions. I love this question from Don. Can AI take over the 50,000 plus tax pros at the big box tax prep companies, and how soon can it do it? Just kidding. I think that's kind of a tongue-in-cheek question, Don. I love the question, though. Can it help me survive and help kill the competition? Another question is, and I'm curious, Bob and LaDonna, how you think about this. Nonprofit receives a 1099K. The nonprofit just files on a postcard. Do they have to do anything to reconcile the 1099K?
If they're under the 50,000, I would think not.
I agree with that answer. I think you're right. If tips are not subject to income tax, Bob, what do you think? Will it still be subject to FICA? In other words, are they still going to have to report their tips and then pay FICA on them?
We lost you, Bob.
I was coughing before and turned off the microphone. But yeah, that is a really good question. I had not thought about it before. It would be beneficial to the tipped employee if it was. So then we're back to the awkward record keeping. I think it would be, probably should be included in FICA.
Yep, I think it is. I think it will be, because it's gonna hurt them in the long run if they don't include it in FICA, because they won't have the Social Security wages when they retire and get double taxed. Couple other questions coming in here. Just curious, we're almost out of time, so I'm going to try to grab just a couple more questions, and we might skip the. Let me just ask this question. What if a person's driver's license expiration date changes, so they get their driver's license updated? Is that going to require additional B of I reporting because that information changed?
It does not.
What if you did what's that?
It will not.
What about if you did an engagement letter specifically for the B of I and asked the client to indemnify you for any mistakes on the B of I reporting? Do you think that's a good idea?
I think some sort of discussion on it and make it clear what your responsibilities are in your engagement letter would be highly recommended.
Yes, absolutely.
And make it specific to BOI. So it's clear later if they fail to inform you of some life-changing event like a move, then it's not on you. You've signed that contract with you.
I have done a poor job of managing our time. We're a little bit, I think we're right at 50 minutes right now, but we're going to go a little bit over. So I have one to throw out there, but just so you look at the results that are, most of you believe more than half of your clients are not going to comply with the FinCEN reporting requirements. And let's just flip down to the very last polling question so we make sure we get it in, and then maybe we'll talk just a few more minutes about the ERC. And probably should have stuck this a little earlier when we were talking about the TCJA stuff, but which of the expiring, I'm sorry, Gail, this is your job to do that. So let's get this last polling question in.
Okay, this is polling question number 4. Which of the expiring tax provisions for TCJA concern you the most? And the options are QBI, the SALT limitation, child tax credit reduction, or something else, other. So pick the one you're most impacted by in your practice.
The polling questions are my favorite part of doing the presentation. I have messed up my viewing screen though, so I can't really see them. So I'm not very good at this. There we go. I was going to see if there was maybe 1 or 2 more questions that we might take while this poll is being done. Let's see if I can get down to them. We got that one. Yep. And okay, that's good. I think we've covered a lot of the questions. Still have some questions around AI, that the ethical considerations around AI. All of those are great questions. Bob, LaDonna, I know that we didn't get to the ERC, and we also did not get to the EV credits. So any closing comments on either one of those that you feel like our attendees should be aware of as we go into this upcoming season? Either one. You pick EV or retention credits. Any comments on either one of those that they need to watch out for?
I think you're going to need to be a little careful with the electric vehicle credits and make sure that they've been properly reported through the dealership. I have had discussions with preparers where this wasn't happening. I saw an example, somebody mentioned having a client that had bought an electric vehicle and he knew for sure the dealer had not reported it, and so now he's kind of stuck in the middle.
Any thoughts on either one of those?
The credit should come through the dealership. Yeah, so they should have that little piece of paper in their hand. If there's actually a physical piece of paper they should have in their hand when they bring their tax information to you that says this vehicle that they purchased was approved for the credit. So that's important. Be sure you're looking for that.
And it's my understanding that is matched at the IRS by the VIN number. The dealer did not report that VIN number as part of their reporting. It's going to be rejected at the IRS when they try to match it up. That's my understanding. And this is the year that all of them have to be. There is no EV credit outside with a private party. Let's put it that way. Even if you, there is no transfer of the EV credit unless you have a dealer involved. So anytime it's used on the trade-in, has to be reconciled on the return. You don't have to claim the EV credit, but if you use it on the trade-in, you have to report it, similar to the premium tax credit that you might receive when you buy your health insurance. The last thing I'll point out is on the employee retention credit disclosure program, open through November 22nd. You pay back 85% of the ERC and you sign a closing agreement. The biggest issue with the ERC credits, for a lot of you that don't do payroll, you may say, well, why do I care? Any wages used to claim an ERC or any ERC paid back inadvertently or paid back for real is going to require some type of amendment on a tax return. So we're going back to 2020, which means that we're losing some time on the statute of limitations on amending tax returns, especially on pass-through entities like S corps, that then will have to amend the individual returns. Bob, LaDonna, any thoughts on any of that amendment stuff? Statute of limitations, ringing the bell?
Oh, yeah. Yeah,
I don't think anybody wants to touch it.
Yeah, that's going to be kind of ugly for those that get caught in it.
I would expect some guidance on from the IRS on some of that, because that was 2020, and if return was filed timely in that piece, we have come up on some statute of limitations issues for filing a claim for refund on some of those. So, all right. I think that's got us through all of our polling questions. And at this point, I think we got them all. And Gail, you can correct me if I'm wrong.
Yep, we got all the
but we'd like to thank you for taking some time. Great. Thanks, everyone. Thanks, Bob and LaDonna, for joining our panel today. And Gail, I'll say thank you too. Really appreciate it. I love talking to Bob and LaDonna. It is always a interesting conversation for me because we can bounce anything off each other. And we do that a lot internally at Drake. So thanks again, and appreciate, Gail, you having us. So Gail, I'll turn it back over to you.
All right. Thank you so much, all three of you. This was a really great presentation. And I even based on comments coming in from the audience, a lot of people wanted to know where they can watch it again or share it with other people. So if you go to cpapracticeadvisor.com/webinars, you'll see this one listed, and we will provide the recording there so it can be watched again in the future. We hope everyone enjoyed this, and we really want to thank Drake for making this event possible and for enabling us to offer free CPE and CE credits for this event. As a reminder, you'll receive a link to your CPE certificate later today in your email. The CE credit information will be submitted directly to the IRS. If you if you submitted your PTIN number on screen here, we recorded all of those. If you didn't have it handy and want to email it to us later, you can do that, and we'll get that information off to the IRS. If you have any questions about CPE or CE credit, you can contact me directly, Perry, GPERRY, at cpapracticeadvisor.com. Also, if others are watching this event with you at the same computer and they require either CPE or CE credit, you can email me their names and addresses, and if applicable, PTIN numbers. Again, that's Perry, GPERRY, at cpapracticeadvisor.com. After we finish here, we're going to present you with a post-event survey evaluation form. We'd appreciate it if you'd take a moment to fill that out. We also would like you to share your feedback with us so we can continue to improve our webinar series. I want to thank you all again for sharing your time with us today, and our audio will end now.
Thank
Bye,
you.
everyone.
You have a good day.
Okay.